Alright guys, this video is going to be a really important lesson for a lot of you. Even though it's going to be quite short, it's really important. Some of you really need to hear this and understand this. So what you can see on your screen here is the FTSE 100 daily chart. For those of you that don't know, the FTSE 100 is basically the UK's major stock index. It's the blue chip companies. And in general, I wouldn't usually use MT5, MetaTrader 5, which you can see on screen here, for any equity indices. I don't think it's particularly the most reliable when it comes to equity indexes, but I'm using it for the sake of this video because it doesn't really matter. It still shows what we need to see. So just keep that in mind. I wouldn't normally use this for it. But anyway, what I want to talk about in this video is something which I believe is one of the major causes for people wiping out an account or at least experiencing heavy losses that they shouldn't be experiencing. And I don't just mean new traders, because if it's a new trader, you can kind of understand it a bit more. They're still learning, making mistakes, improving. I'm talking people that are considered to be experts as well, people working in major institutions, people that should know much better. And I'm talking about it links to the whole situation of marrying your trade. You may have seen in any list of trading rules, one of the rules is usually going to be don't marry your trades, or don't marry your positions, don't marry your ideas. It's basically those situations when someone has so much conviction in a certain direction of the market, whether they think it's definitely going to be going up or definitely going to be going down, because they're so convinced by their analysis and what they're seeing, it causes them to get sidetracked and forget sort of the principles of their trading, because they look at this situation, whether it's because of fundamental analysis or technicals or whatever else, and they think there's no chance this can keep going up, or there's no chance this can keep going down. This is something that I did early on in my trading career. For the first few years, I'd fall into this trap a lot. I'd think the market's going to be correcting from here, and every time it kept going against me, I'd just think, oh, you know what, the market's just like slow to catch up with thinking. They'll get there eventually. But the thing about trading is it's not just about picking the right direction in the market. That's a 50-50 bet. It's also important to get the right timing, because you could be correct in predicting the market's going to crash, but if you do it a year too early, then you can get wiped out. So in that sense, we need to not marry our positions, not marry our trades. And when I say that people do it in institutions like hedge funds and investment banks, it really happens. You hear about these trades that are called like the widow makers, where it's like people shorting certain bonds and so on. And it turns out like it carries on in that direction for the next 10 years until finally it reverses. But in that 10 years, it wipes out lots of traders that thought that they had picked the trade of the century, and then they just get wiped out because they're too convinced by what they're seeing. But anyway, I want to talk about like how I avoid that situation. So I want to show you like three very similar situations. I want to show you the FTSE 100, which is here. You can see the past 2 months have had big bullish momentum, a big bullish trend, reaching new highs. We can also see with US dollar Swiss franc, we had that big bullish momentum recently around the same sort of time as the FTSE. And then I want to show you another market, which I'll come on to in a second. So with the FTSE, during the time that it had this bullish momentum, if you're following our market selection service, then you'll know that I picked up on the FTSE as a potential market some of the days, because it was interacting with our significant levels. I was saying let's wait for some structure to build for potentially moving in a bearish direction, moving down. And I had some good trades there, also had some trades that hit stop loss. But more recently, we've interacted with some really major levels, including today, one that I don't have on the chart. We had this trend line, which I haven't drawn, but you can see with these highs, the trend line that we were interacting with today on the daily and on the weekly as well. And yet I didn't pick it up for my market selection. I wasn't trading it. But on the other hand, with US dollar Swiss franc, we had that same situation coming up here, and I was still picking it around here as being a potential market. So what's the difference? Well, basically, every time that the market interacts with our significant levels, even if it continues to move through that level afterwards, we at least want to see that the market's respecting it. So when it comes to Swiss franc, US dollar Swiss franc, every time it approached the significant levels, it at least reacted to them in the way you'd expect it to. You can even see here with this sort of legacy level that I've got on there, that it broke through the level and then closed the type 2 from the other side and then pushed up. So because of that, then you can have some conviction that every time it reaches your significant levels, then at least it's going to respect those levels. Now, it might push through afterwards and go against you, but that's fine, because that's what your stop losses are for. But you know that there's a chance that one, you can maybe pick up a smaller trade in the meantime, or two, you're going to finally get the one that ends up being a much better trade, like up here. For example, if we were looking around here, then that's quite a big move down there that you could have picked up on. So that's just like in essence what I'm saying, like when People say don't try and catch a falling knife, but I would disagree and say you can try and do that in the market as long as you have specific criteria for what you're looking for and what your exit would be. So you don't try and catch like around here when there's all that momentum. You don't try and short it and just think that it's going to finally go in your direction, have no reason for for actually opening that trade. You have nothing to base it on. But if you've got analysis there, then you know that once that analysis is broken, if it's a significant level, once the price closes through that, you can exit, then you know you've got relatively smaller losses on the way to potential big ones. So that's why I was still picking up in US dollar, Swiss franc up until now it starts to move down. The potential sort of move down has gone because obviously it's happened. But on the other hand, with the FTSE, I've ignored it recently and it's getting to new highs, which means that if you had a bearish bias at certain points in time, then surely there's more potential up here. So why am I excluding this one? Well, it's because every time that we had the significant levels recently, it wasn't respecting them in the way that I expected. So in those situations, if you have a market, and obviously this time we're looking at a daily chart with a strong trend, but you can even look at this on a 15-minute chart with a weak trend or a 1-hour chart with a strong trend or whatever it might be. If the market's not respecting your significant levels, then that's a sign that either your analysis has been wrong all along, your significant levels aren't mapped out properly, or the market is behaving in a way that like the underlying sort of, let's call it the underlying current in the market is not what you expect it to be. It's not what's normal. And that's what I've been seeing happening with the FTSE. So every time there's a significant level there, the thing that you expect to happen is not happening. And therefore you think it's maybe not in those normal steady state markets that we like to trade for the Duomo method. Maybe there's something else going on there. There's other sentiment. Maybe it's a bit of herd activity in a way that we can't quite explain. So in a nutshell, that's why I've been avoiding the FTSE for the last couple of weeks. Whereas with US dollar, Swiss franc and other sort of trending markets, I've been okay going for it, even if it goes through the significant levels. Because on one hand, one of them, you know that there's a certain probability percentage that is acceptable for the risk reward that you're having. So you can take these smaller losses because you know based on the probability, eventually you're going to have a successful trade that will be worth more than the losses you had in that meantime. Whereas with FTSE, the success probabilities drop significantly because every time that I'm going in for a trade based on a significant level and a setup, then actually there's too much of an element of luck because the significant levels are not being respected, which means that they're just arbitrary levels on the chart. Now, this happened last year with the Dow, and this is just the last one I want to show you. Ignore the levels that were on the chart, they're just there from other demonstrations that I've done. But basically, all through last year, I started to have a sort of fundamental conviction that the market needs to correct at some point. And so it was around this time here, October, November sort of time, that I started trying to anticipate that with some short trades. Once it started to flatten out, the structure was nice on the intraday. Had some really nice trades actually, but not in a size that I wanted. It wasn't a position that I wanted. The market broke through, and at that point, it started to not respect the significant levels again, in the same way that it didn't for a lot of the time in this section around here. So for all this time, I didn't get involved in the Dow, haven't been involved in the Dow for probably a few years. Up until this point, I started to get involved again. But once it started to go back to the activity that was going on here, around the time of the tax sort of situation being sort of resolved, around December sort of time, the market sort of reverted back to not being the usual steady state, that there's a different currency in the market. So I left it, understanding that I'm going to miss out when that correction finally happens. And you can see in February, it happened. Huge move. If I was still looking for bearish trades then and I was still jumping in then, I would have made an absolute killing. But that's fine, because if you're anticipating a big move, if you've got certain conviction that's making you go for that same market every day, then you know that if there is a move happening, you can still capitalize on it just a little bit later. So what happened a little bit later in February, mid-February, I capitalized on it at that point instead, and probably made the sort of biggest single trade gains that I've made in a couple of years. I think 2 or 3 trades were absolutely huge at that point. And that's because at that point it starts respecting the structure again. It was going down the trend line along here. It only recently broke through it, but it starts respecting the structure again. I see that things have changed. I see that things are in my favor and there's something to base my analysis on. I'm not just jumping in at arbitrary levels that the market's not respecting. Things have changed. And so basically, if I'm going to sum up what I'm saying in this, that yes, you can have real conviction in what's going on in the market that is either correct or not. but your timing can be way off if you're not respecting what the market's showing you. And at certain times, significant levels are not going to be respected, and that's a major clue that there's something odd going on in the market that you need to step away from that market. So there's two situations really. There's a situation where you've got a lot of conviction in what the market's going to do, and it's not doing that, and at some point you've got to step away and accept that you're wrong, or at least have stop losses that are going to minimize the loss you're making. And on the other hand, you see that you've got significant levels, you've got reason to enter, but it's not respecting those levels, so likewise you've got to step away from it. So I think I've gone over the same point enough now that you probably get what I'm saying here, but if you do have any questions, leave them below. This is just something that came to my mind that I wanted to talk about, because there's been so many strong trends recently that it's so easy to get caught out on them, especially if you think that it shouldn't be happening in the way that it's happening. But it's good to have these triggers in your system that help you to step out of the market, that you don't have to rely on your own willpower to step away from a potential big opportunity. It's in your system, so you're not clouded by your judgment on this situation. You're actually following a system, you're following an approach that you know is going to keep you safe, and that's the most important thing. Protect your capital at all times. Anyway guys, like I said, any questions, comments below. If you like the video, please do hit the thumbs up. Don't forget to subscribe and switch on notifications. And you may have heard me mention the market selection service earlier in the video. It's free to join, the link's in the description box, and then you can find out which markets I'm following each day and why. Thanks a lot for watching. Sorry it went on a little bit longer than it should have done. Take care, and I'll see you in the next video.